MA1 Part E. Providing Management Information. Chapter 10. Variances. The topics that this presentation will cover are 1. Calculating variances. 2. Sales revenue variances calculations. 3. Cost variance calculations. 4. The reasons for cost variances. 5. Exception reporting and investigating variances. 1. Variance reports help budget holders to perform the function of control. The reports are very useful if they separate controllable variances from non-controllable variances. A favorable variance is when the business has more money as a result of the comparison between the budget and the actual. An adverse, unfavorable variance is when the business has less money as a result of the comparison between the budget and the actual. A favorable variance is not always good for the business. Whether it is good or bad depends on the reason for the variance. 2. There are 3 types of sale revenue variances. The total sale revenue variance, the activity or volume variance, and the selling price variance. The total sales revenue variance equals the activity variance plus the selling price variance. The total sale revenue variance also equals the budgeted total sales revenue less the actual total sales revenue. For an example of how the total sales revenue variance is calculated, see the example on page 179 of your interactive text study guide. Stop the lecture. Answer the question on page 179 of your interactive text study guide. The activity or volume variance is the difference in the quantity sold between the budget and the actual. A flexible budget is a budget that can be adjusted or flexed to reflect the same production or sales levels as was actually achieved. That means that the quantity difference, which is what this variance shows, is taken out of the equation, and only the selling price variance is calculated. The activity or volume variance equals the budgeted volume less the actual volume multiplied by the budgeted selling price per unit. For an example of how the activity or volume variance is calculated, see the example on page 180 of your interactive text study guide. Stop the lecture. Answer the question on page 180 of your interactive text study guide. The selling price variance equals the budgeted selling price less the actual selling price. For an example of how the selling price variance is calculated, see the example on page 180 of your interactive text study guide. 3. There are 3 types of cost variances. The total direct cost variance, the activity or volume variance, and the purchase price or efficiency of usage variance. The total direct cost variance equals the activity variance plus the purchase price or efficiency of usage variance. The total direct cost variance also equals the budgeted total cost less the actual total cost. For an example of how the total direct cost variance is calculated, see the example on page 181 of your interactive text study guide. Stop the lecture. Answer the question on page 181 of your interactive text study guide. The activity or volume variance is the difference in the quantity produced between the budget and the actual. A flexible budget is a budget that can be adjusted or flexed to reflect the same production or sales levels as was actually achieved. That means that the quantity difference, which is what this variance shows, is taken out of the equation, and only the price or efficiency variance is calculated. The activity or volume variance equals the budgeted volume or quantity less the actual volume or quantity multiplied by the budgeted cost price per unit. For an example of how the activity or volume variance is calculated, see the example on page 182 of your interactive text study guide. Stop the lecture. Answer the question on page 182 of your interactive text study guide. The purchase price or efficiency of usage variance equals either the budgeted production cost less the actual production cost, or the budgeted labor cost, less the actual labor cost. For an example of how the purchase price or efficiency of usage variance is calculated, see the example on page 182 and 183 of your interactive text study guide. Stop the lecture. Answer the question on page 183 of your interactive text study guide. 4. There are many reasons for adverse and favorable cost variances. These listed below are only a few of them. Under the material price variance, the reasons for a favorable variance could be: an unforeseen discounts was received. More care has been taken in purchasing materials. The reasons for an adverse variance could be: there was a price increase. There was careless purchasing. Under the material usage variance, the reasons for a favorable variance could be: the material that were used were of a higher quality than standard. A more effective use was made of the materials. There could be errors in allocating material to jobs. The reasons for an adverse variance could be: there was defective material. There was excessive waste. There could have been a theft of materials. There has been stricter quality control. There could be errors in allocating material to jobs. Under the labor rate variance, the reasons for a favorable variance could be: there was a use of apprentices, or other workers that work at a pay rate lower than standard. The reasons for an adverse variance could be: there has been a wage rate increase. There has been a use of higher grade labor. Under the labor efficiency variance, the reasons for a favorable variance could be: the output was produced quicker than expected, due to work motivation, better quality of equipment, materials, or better methods were used. There were errors in allocating time to a job. The reasons for an adverse variance could be: there was a loss of time, in excess of the standard allowed. The output was lower than the standard set, due to a deliberate restriction, lack of training, or substandard materials were used. There were errors in allocating time to a job. 5. Budget are used to give financial responsibility to managers, by making a manager, that is responsible for a section or department, responsible for that section or department's expenditure. These managers are also called budget holders, and will have to decide what to do if costs are too high, or revenue is too low. These budget holders need to be informed of any variances that needs to be investigated. They should not be bugged with immaterial variances, but large variances and variances that show a worrying trend should be reported to them. Reporting to budget holders is sometimes called responsibility accounting. Most businesses use a system of exception reporting. Exception reporting highlights the variances that need investigating. These reports only report the variances that exceeds a certain amount or percentage. The decision to investigate a variance depends if it is controllable or non-controllable. A controllable variance can be rectified by the manager. A non-controllable variance, which are due to external factors, are out of the manager's control. The manager needs to be able to explain why the variance occurred, and should take whatever action is needed. If the variance is controllable, then the manager can take steps to rectify it, and if it is non-controllable, then the action plan needs to be revised. Either way, the manager is not necessary to blame for the variance. A variance should only be investigated if the benefit of the investigation will outweigh the cost of the investigation. When investigating a variance, remember that variances can be interdependent, which means that a single factor can affect more than just one variance. A manager will investigate a variance, and if it is controllable, then the manager can rectify it, and if it is non-controllable, then the manager should adjust the budget. This system is called feedback control. If a variance can be foreseen, and a manager can take corrective action in advance to prevent the variance, it is called feed-forward control. Stop the lecture. Answer the question on page 186, 187 of your interactive text study guide. This is the end of Chapter 10. What will follow next is the quick quiz. After the quick quiz, do the online questions for Part E, Chapter 10. It will be good practice because the online questions are set out like the exam that you do at the end of the course. They will also test your knowledge of this chapter. Quick quiz. Question 1. A difference between planned and actual results, which results in the organization having less money than forecast, is called A favorable variance, B an adverse variance, C a loss, D a profit. Question 2. Statement 1. An adverse variance is always good for the business. Statement 2. An adverse variance is always bad for the business. A. Both statements are false. B. Both statements are true. C. Statement 1 is true but statement 2 is false. D. Statement 1 is false but statement 2 is true. Question 3. Which of the following statements about exception reporting is false? A. It avoids information overload. B. It makes it easier for managers to spot important variances. C. It reports variances which exceed a certain amount or percentage. D. All variances highlighted should be investigated. Question 4. What is the name given when a variance is foreseen and the manager takes corrective action in advance of the problem to avoid a variance? A. Feed-forward control. B. Feedback control. C. Neither of the above. Question 5. Which of the following options describes an activity variance? A. The actual efficiency in which resources are used being different to budgeted efficiency. B. The actual quantity produced being different to budgeted production volume. C. The actual cost pricing being different to budgeted cost price. D. The budgeted efficiency in which resources are used being different to actual efficiency. Question 6. HFCO budgeted to produce 3,000 units of product in June. The budgeted materials for were 1,500 kilograms at a cost of 3 rands per kg. The actual number of units produced was 2,200 and variances were as follows. Direct material price variance 825 rands, adverse. Direct material efficiency variance 1,650 rands, adverse. Calculate the actual direct material kilograms used. A. 550 kilograms. B. 1,100 kilograms. C. 1,650 kilograms. D. 4,950 kilograms. Question 7. Using the information in question 6, calculate the actual direct material cost for June. A. 825 rands. B. 4,125 rands. C. 4,950 rands. D. 5,775 rands. After doing the quick quiz, do the online questions for Part E, Chapter 10. Do the questions, until you achieve 80%. Replay the lecture as needed.